Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. Well, it's Monday and we got the stock market back open. I just love Mondays. What's going on today? Having an update. Dow's up about 100. NASDAQ's up about 100. All right. So to me, it looks like the stock market is overly optimistic. It's kind of priced for perfection, if you will. Now, the VIX is extremely low. Extremely low. Now that means that there's no fear in the marketplace, that the market has complacency. Nobody's worried that the stock market's going to go down anymore. Now what I see is this resembles a lot like the dot-com bust, right? We had the dot-com boom and then we had the bust. Now this goes back to 2000, so a lot of you probably weren't even trading back then, but let me tell you how it went down. All right, so you had this big run up, right? And then you had a 38% collapse in the NASDAQ, followed by a 40% run up, but then it came down 80%. Now what we got right now is the exact same thing. Down 38% on the NASDAQ, about a 40% rebound almost. And soon we're going to get that downfall if it plays out like it did in the dot-com bust. Now I think it's very similar, and I do think that it's going to come down 80%. That might be extreme right now, but I think we're going to get a pullback. I think things are overly optimistic, and I do think that once this starts to break, you're going to see it break pretty hard, and it's going to be relatively soon. Over these summer months, we're going to have this downward pattern. But now I've got this completely wrong, so you may have a completely different take. A lot of people think we're going to hit new highs. I mean, we're only 400 points off a record high in the S&P, right around that 4,300 level. You get up to that 4,700 level, you're at record highs. That's what a lot of people think, that this is the new bull market. That's not my take, but I did not expect it to rally up this high. All right, let's get over to the housing market. Now, the housing market, over the weekend, you always get those exciting articles, right? Here was the headline. U.S. homeowners see first equity loss since 2012. Okay, so home prices are coming down. They have the first equity loss year over year. All right, that's true, but things are still priced at unaffordable levels. It's not sustainable. Only 20% of people can afford the homes right now. Most people couldn't even buy back the homes that they live in. However, now the Biden administration, they come out with programs. You can't make this up. If you have no money for the down payment and you have really bad credit, we want to put you in a house anyways. That's the programs that are out there right now. 1% down payment, and you don't even need to have that. If you just spend a lot on a credit card, they'll give you the 1% to 0 down, and bad credit gets you a lower rate so everybody can get into a house. Look, I think that we're stuck right now. I think we're stuck. You can tell by the market, right? It's down 30% year over year number of transactions, and you got foreclosures going like this, right? Foreclosures are going up 14% up year over year, but you got prices going like this, prices coming down. This is not a good sign for the future of the housing market, but a lot of people think that we're going to get new record highs in the housing market. I see it that we're kind of stuck right here. We're kind of stuck. People can't move. They're stuck. They got that 2.8% rate. They're not going anywhere because rates have shot up past 7%, headed towards 8%. 8% if you already have bad credit. But a lot of people are stuck. You can't downsize, can't upsize. You're just kind of stuck where you are, right? Okay, so now what there's a lot of talk about right now is the assumability of your mortgage. You see, people have these mortgages locked in like at 2.8%, 3%, 2.9%. All these mortgages, they're stuck, right? But some of these mortgages are assumable. And that's what this article was saying. Some of these mortgages are assumable. And I thought to myself, who would be stupid enough to write an assumable mortgage for 2.8%? Who could it be? Oh yeah, that's our government. Our government does that. FHA loans and VA loans. These are government programs and they make the loans assumable. Oh, that's fascinating to me. All right. All right. So here's what we got. Here's what we got. You can have two identical houses on the street, right? Let's say they're for $500,000 each, and they're next door neighbors. Okay, well, one's for 500,000, one's going to be for 400,000. Now, why is the one at 500,000? Well, they're the one with the assumable loan, right? Because you're going to pay that premium if you can assume the loan. And there's only about out there, I'd say probably less than 20% of loans that are these FHA and VA loans that are actually assumable. Most of the commercial banks, they're not that stupid, right? They would never write an assumable loan that's under 3%. No, they want to get that loan paid off as soon as you sell the property. They want to get their money back. They don't want to let you give that 2.8 loan to someone else. Now, could the government come out and make all loans assumable? I suppose they could, but I don't think they will, because that would put this extreme pressure on the banking system. Now, the banking system is already under extreme pressure, right? Because most of their assets have got cut in half. They're worth half what they were. But yet, if people want their money back, they wouldn't have their money back. They'd have to sell these assets at a reduced price. So the banks are in serious trouble here. Now, we've had three of the major ones go under already. Now, that's 3 out of the top 30, so 10% of the banks already went under. And there's going to be many more because the banks are under pressure. And that's why I don't think the government will make a law saying that all loans are assumable, because you see, the banks are the losers in this mortgage crisis, if you will, where the mortgages that they're carrying at 2.8%, they want to get those off their books as quickly as possible. The only way to get them off the books is for you to sell the property to someone else. But I know you're never going to sell that property. You got it at 2.8%, and you're a little bit lower than your neighbor. There's this rate envy thing. Your neighbor got 2.9, but you got 2.8. Now, who has the most equity? Well, you can look at Redfin, you can look at Zillow, and you can compare equity. Who got the most equity? There's a lot of equity envy. There's a lot of rate envy. But you see, there's a problem here because everybody is stuck. Everybody's stuck, right? Okay, so they're all stuck in these properties. They can't sell them unless they can transfer this portability thing. But the portability thing, their banks aren't going to allow, because the banks are under a lot of pressure. Now, where else are the banks going to come under pressure? You watch over the course of this summer, there's going to be extreme pressure on the banks. About $2 trillion, almost $2 trillion more is going to come under pressure. Now, what's that? That's the commercial loans. Commercial loans that these banks are carrying, and most of them are being carried by the regional banks. Well, these commercial loans are in huge trouble, right? All right, now I live close to San Francisco, just in the South Bay from there. But okay, so two of the major hotels, right? They just handed back the keys. They shuttered the hotels. The hotels aren't open. They just closed them up. These are the Hilton, right? Okay, so they gave two of them back. You know how much the loans on those were? $700 million, almost $1 billion. And these are just two properties all across the nation. This is going to be happening in the commercial end. This is going to be happening. Now, the office high rises, they're handing those back. Well, some of them are selling them at extreme losses, right? Okay, so anyways, Wells Fargo, they sold one 70% off. It took a $60 million hit. The other one, Union Bank, sold it 75% off. These office buildings are already 75% off. Now, a lot of the people that carry this paper, they're going to lose out, because they're just going to send the keys back eventually. Okay. Now, sometimes they're locked in, but these are not locked in for 30 years. These are 5 years, right? 5 years. Okay. Every 5 years they have to refinance these office buildings, and at this higher rate with the vacancy rates now. Many vacancy rates in San Francisco, 70% vacant. So they're not bringing in the rent to pay these higher rates that they have to refinance at. So they're just going to give these keys back. So this is putting the pressure on the banking system. The banks are under a lot of pressure, and we're going to see a lot more banks go under, right? That's just the way it's going to happen. But we got a problem that America is stuck, and we got to figure out how to get them unstuck. Now, here's the thing. All right, so let's say you bought your house. You know, a lot of houses sell for the $1 million range across the country, high end, some only up to $500,000. But I like using round numbers, $1 million. You bought your house for $1 million, and hey, you're fired up because you got 2.8%, right? But your house is starting to go down a little bit. Maybe it's only worth $950 now, maybe only $900,000, but you're locked in because you got 2.8%, right? So you don't care. You don't care if they go down, but all of a sudden they keep falling, right? Now I'm calling for a 50% off sale. That's what I'm calling for. About 40% down from here. We're already down about 10% in most areas, but 40% more to go, right? So you're in the $1 million price, but all of a sudden your neighbor's house, exact same house right next door, they come and they sell it for $500,000. But that poor guy that bought that house for $500,000, you know he has to pay 7%, almost 8%. But he's got to pay. So you can walk over, knock on his door and go, hey, I got mine for 2.8%. And he can say, hey, you're $500,000 underwater. I got mine for $500,000, but yeah, I'm paying that 7 or 8%. Hey, let's compare property taxes. Hey, my property taxes are $5,000. Oh, yours are over $10,000. Oh, mine are half of yours, but you're locked in at 2.8, so you're happy, right? I mean, this rate envy thing is not going to play out well over the long time. And this equity envy, that's going away. There's going to be negative equity envy. I don't know. Could you have such a thing? I suppose you could. I mean, people comparing how far they're underwater. Hey, I'm only 400,000 underwater. Oh man, you got me beat. I'm 450,000 underwater. There's going to be negative rate envy coming. That's my opinion. Now, your opinion, and of course, in your area, everything goes up. Everything goes up, right? It's possible. I suppose it could play out that way. But here's another headline out that came out this weekend. Anyways, falling home prices could strain financial markets as interest rates increase. That's a headline. And that's pretty common sense. Now, I don't want you to think that it's just the United States that's in trouble. No, the United States is probably going to fare better than a lot of the world. You see, a lot of the world does not have the 30-year mortgages. They have the 5-year mortgages that are refinanced every 5 years, and they're going to have a lot of problems in their real estate market. So this is a worldwide problem. The worldwide real estate problem right now is going to come crashing down. Now, I know in your area, it's going to be safe. It's going to be okay because your area never goes down. Anyways, this is just my opinions. And look, I know a lot of people don't like my opinions. They don't like what I have to say, but they come and they watch the channel anyways. They leave me comments down below. And I love y'all. I love the people that like what I have to say and the ones that don't like what I have to say. We don't have to agree on everything. Look, what I want you to do is make up your own mind, make up your own decisions. Now back to the stock market, right? Are we going to head higher? Maybe we hit that record high. Are we going to head lower? That's my take, but people say, but Mike, it's different this time. It's not like the dot-com crash. This time we have AI, we have artificial intelligence. That's going to create the stock market run of a lifetime. You got to get in before it's too late. Now, that's a lot of people's takes. And on the housing side of things, a lot of people think we're going to new highs. They think that they're going to be the next Billy Bob. I'm telling telling you, Billy Bob's just sitting back, relaxing, still on vacation, waiting for it to play out. And it may take a year or two for all this to play out, but mark my words, it's going to play out. That rate envy is going to go away. That equity envy is going to go away. It's going to be a different market a year from now. Probably going to be a different market by the end of this year. I don't think it's going to hold up that well. We're in the peak selling season and people don't want to sell. Why don't they want to sell? They don't want to sell because they feel the market has gone down. They don't want to sell into a down market. They want to wait for the Fed to pivot so the prices can get up to where Billy Bob got out at. I'm telling you, Billy Bob got out at the high. When the Fed pivots, the prices are going to come down. It's counterintuitive, but that's how it plays out. Look back to the 2008 crisis, right? That was the subprime mortgages. The Fed pivoted in 2009. Took another 3 years. 2012 is where we bottomed out. And most of that crash came after the 2009 pivot. The Fed, sure, they could pivot. Maybe by the end of the year it's possible. I don't know. But once they pivot, that's where the bad stuff starts to happen. Anyways, I'm Tall Mike. If you like this stuff, give me the thumbs up. Why not? It's Monday. I love Mondays. Get out there, everybody. Have a great day. We'll talk again real soon. Bye-bye now.